responsibility accounting, performance evaluation, and transfer pricing. In other words, we have to take up the three topics under decentralization: responsibility accounting, performance evaluation, and transfer pricing. Okay, so take note. Learning objectives: define responsibility accounting and describe the four types of responsibility centers. 2. Explain why firms choose to decentralize. 3. Compute and explain return on investment or the ROI, residual income, and economic value added. 4. Discuss methods of evaluating and rewarding managerial performance. 5. Explain the role of transfer pricing in a decentralized firm. And 6. Discuss the methods of setting transfer pricing. So that in the 6 objectives, here we are including responsibility accounting, then we have transfer pricing, and at the same time we have to consider the formula in connection with our investment returns. Okay, so we have now these objectives. Now, responsibility accounting is a system that measures the results of each responsibility center and compares those results with expected or budgeted outcome. Now, responsibility center is the part of the business whose manager is accountable for specified activities. Now, remember that the manager or the head of the department or of the center is accountable for the cost that he is responsible. So, in other words, what are the costs that he is responsible? So meaning he is accountable for these costs. Now, system of responsibility, accountability, and performance evaluation. Now, types of responsibility centers, we have 4. Cost center, the manager is responsible only for cost. Revenue center, he is responsible only for revenues. Profit center, the manager is responsible for both revenues and cost. And investment center, the manager is responsible for revenues, cost, and investments. In other words, ang most complicated of the 4 is the investment center. Now, decentralization is the practice of delegating decision-making authority to the lower levels. Decentralized decision-making allows managers at lower levels to make and implement key decisions pertaining to their areas of responsibility. Centralized decision-making, decisions are made at the very top level, and lower level managers are charged with implementing those decisions. Now, when we talk about decentralization, in other words, there is delegation in terms of decision making. So, for example, you have the overall manager, you have the, let's say, the CEO of the company, we have the president, and we have the department heads or the department managers. Like, for example, in a company, we have the production manager, we have the marketing manager, we have the office manager. Now, these are the different heads in the company. And of course, we have the president, we have the vice president for finance, for administration, and if there is decentralization, now the individual manager or the department heads are given the authority to decide, given the authority to make decisions in their levels, now the lower levels. So in other words, there is delegation of authority, no, delegation, that these lower level managers can make decisions at their levels. Now, however, on the other hand, if we are dealing with centralization, in other words, it's the top management that decides, and the lower level heads will only follow. Now, for example, in budgeting, if you are following um, decentralization in every level, like the marketing department, the production department, they will prepare their own budgets and send it for approval by the higher management. Now, in other words, the budgeting process is called bottom up. The initial budget comes from the lower level management, and this will be sent to the upper level head, or to the general office, or to the uh, higher authority for final approval. So we call it bottom up. However, on the other hand, if the budgeting process is one that is considered to be centralized, so the upper level or its top management that prepares the budget only for implementation by the lower level. Now that is called top down. Okay, so again, we have decentralization and centralization. Now the reasons for decentralization: better access to local information, cognitive limitations, more timely response, focusing of central management, training in the evaluation of segment managers, motivation of segment managers, and enhanced competition. Now, it would be a competition among the different departments with their corresponding heads. Now, the units of decentralization achieved by segmenting the company into divisions. Divisions can be differentiated by the types of goods or services produced. Companies create divisions according to the type of customer served. Performance evaluation measures for investment centers. Now we have the return on investment, or the ROI, residual income or RI, and economic value added, or the EVA. So we have now the performance evaluation measures. Now return on investment, or the ROI. Its most common measure performance for an investment center, used by stockholders to indicate the health of a company and used to measure the relative performance of divisions. Now, return on investment, or the ROI, we have this formula. Operating income is now compared, no, with the average operating assets. So, operating income is taken by dividing here. We have the operating income over sales and the average operating assets. Here we have sales and divided by the average operating assets. If you are going to eliminate the denominator and the numerator, which is sales, then the resulting formula will be operating income divided by average operating assets. Now, the operating income margin times the operating asset turnover, that will now give us the ROI. So, operating income margin multiplied by the operating asset turnover, that will finally give us the ROI. Or eliminating sales, that will finally give us operating income divided by average operating assets, wherein the average operating assets is taken by adding the beginning net book value and the ending book value and divide the total by 2. So that will give the average operating assets. Operating income is earnings before interest and income taxes and is typically used for divisions. So usually we call it EBIT. EBIT. E stands for earnings, B for before, I for interest, and T for taxes. EBIT. Now we call it EBIT in short. Then the operating assets, all assets used to generate operating income. Now these are the formula that we need in computing the ROI. Now, component ratios of ROI. Margin, ratio of operating income to sales. So, we have now the first formula. Operating income divided by sales is margin. Second formula is turnover. Sales divided by average operating assets. So, we have now sales divided by average operating assets. So, in short, we now have the operating income or the EBIT and the operating assets used to generate operating income. And in short, the formula is operating income, that's operating income over sales, is operating income margin, and then we multiply it by the operating asset turnover, which is taken by dividing sales by the average operating assets. So in short, the formula is operating income margin multiplied by the operating asset turnover. Next, we have the advantages of the ROI measure. Encourages investment center managers to focus on the relationship between sales, expenses, and investment. Encourages cost efficiency, and discourages excessive investment in operating assets. Now, the advantages of the ROI measure. On the other hand, we have the disadvantages of the ROI measure. Discourages managers from investing in projects that decrease divisional ROI but would increase profitability of the company overall. Encourages managers to focus on the short run at the expense of the long run. Now, the disadvantages of the ROI measure despite the advantages. Now, calculating average operating assets, margin, turnover, and ROI. So, we now have sales, operating income, operating assets, beginning and ending. So, we have now to compute for the average operating assets, beginning plus ending divided by 2. So, the average operating assets is $10 million. Now, computing for the operating margin, we divide operating income by sales. So, we have now the operating income given at 1.8 million divided by sales. So, we have now the margin equal to 6%. Okay, and of course, we have the average operating assets equals 10 million. Now, computing for the turnover or the operating assets turnover, we divide sales by the average operating assets. So, sales divided by the average operating assets. Sales of 30 million divided by the average operating assets of 10 million. We now get the assets turnover equal to 3. So meaning your operating assets are turned over 3 times in connection with the earning of sales. So the ROI now is taken based on the formula by multiplying the margin by the turnover. So it gives 0.6 or we have 6% multiplied by 3, so that gives us 18%. Or we divide operating income by the average operating assets, we get the ROI equal to 18%. Now, second formula that we need to understand and use is residual income. The difference between operating income and the minimum dollar return required on a company's operating assets, residual income is equal to operating income minus the minimum rate of return times the operating assets. So residual income is equal to the operating income minus the minimum rate of return times the operating assets. Residual income or RI, the advantages, dollar measure of performance, refocuses the managers on dollar profit. Disadvantages, absolute measure of return that makes it difficult to directly compare the performance of divisions, does not discourage myopic behavior. Now, calculating residual income. Now, residual income. The company provided the following information for Appliance division for last year. Sales, operating income, average operating assets. Now, the company requires a 12% minimum rate of return. So, calculate residual income for the Appliance division. The residual income is operating income minus minimum rate of return at 12% multiplied by the operating assets. So we now get 3.510 million minus your minimum rate of return. We have the difference of residual income of 1,170,000. Okay, so ROI with that formula, and then we have residual income with another formula. Then the next term is economic value added or EVA. After tax operating profit minus the total annual cost of capital. Positive EVA is the company is creating wealth. Negative EVA, the company is destroying wealth. Encourages managers to use existing and new capital for maximum gain. EVA, after tax operating income minus the weighted average cost of capital times the total capital employed. That's now your EVA, after tax operating income minus the weighted average cost of capital times the total capital employed. So that's your EVA. Now, calculating the weighted average cost of capital and EVA. The company had after-tax operating income last year. 3 sources of financing were used. 2 million of mortgage bonds paying 8% per year. 3 million of unsecured bonds paying 10% interest. And 10 million in common stock, which was considered to be no more or less risky than other stocks. So all in all, the total of 15 million for the after-tax operating income. Okay? So 2 million, 3 million, and 10 million in determining weighted average cost of capital. Calculate the weighted average cost of capital in EBA. Rate of return on long-term U.S. Treasury bonds is 6% and Foreman Incorporated pays a marginal tax rate of 40%. Calculate after-tax cost of each method of financing, weighted average cost of capital for Foreman, total dollar amount of capital employed for Foreman, and economic value added for Foreman for last year is Foreman Incorporated, creating or destroying wealth. So we have now three sources of capital: 2 million of mortgage bonds, 3 million of unsecured bonds, 10 million in common stock. Okay, so we now determine the after-tax cost of each method, and then the weighted average cost of capital, dollar amount of capital, and the EVA or economic value added. So we have now the after-tax cost of mortgage bonds. Interest rate minus the tax rate times the interest rate. So the interest rate on the bonds is 8%. Then we deduct 4 times 0.08. So you now get 0.048, the after-tax cost of mortgage bonds. So we have now the interest rate minus the tax rate multiplied by the interest rate. So the interest rate is equal to 40% and the tax rate is here we have 8%, that's your interest rate. So we have now the interest rate, and then we multiply it by, the formula is tax rate 40%, interest rate 8%, and 8% is the interest rate. So we now multiply after tax cost of unsecured bonds. Again, we have the unsecured bonds. Here it's 3 million of unsecured bonds paying 10% interest. So the unsecured bonds, 10% minus 0.4 times 10%. Now that gives us 0.06. That's the after-tax cost of unsecured bonds. Okay, so that gives the interest rate minus the tax rate times the interest rate for the alternative formula. The cost of common stock is the return on long-term treasury bonds plus you have now the average. So we have 0.06 as you are now given your 10 million in common stock, which was considered to be no more or less risky than the other stocks. So we are now using the cost of common stock, return on long-term treasury bonds plus the average premium. So that now gives us 6%. The return on the long-term treasury bonds, here we are given 6%, and we have the average premium equal to another 6%. So the average premium plus the return on the long-term treasury bonds, that gives us another 6%. So that is now equal to, calculating the weighted average cost of capital and EVA. We have the amount of capital, then the percent, 4 percent of interest, then the after-tax cost of the debt. So we have the weighted cost. Now, the after-tax cost of debt, as we have already computed, the after-tax cost of debt is given to be 0.048. The after-tax cost of the unsecured bonds is 0.6, and for the common stock, so we have now 12%. So all in all, we have the weighted cost of capital. We multiply the after-tax cost by here, the weighted average. We have the amount, the percent. How did we get the percent? It's the proportion. It's the proportion. So if you're 2 million, 3 million, 10 million, so we get 15 million. 2 over 15, that gives us 0.1333. 3 over 15 is 20%, and then 0.15 is 66 and 2/3%. Now that is how we get the percent. Okay, so amount given, then percent computed. Okay, percent computed by considering the proportion. So for the mortgage bonds, it's 2 over 15. For the unsecured bonds, is 3 over 15. And for the common stock, it's the difference, no, of 10 over 15. So you now get the percent, and you multiply the percent here. We have the after-tax cost that we have computed in the previous slide. So you have now the weighted cost, multiplying the percent by the after-tax cost. So we have the weighted cost. The total of the weighted cost is 0.0984. That's your weighted average cost of capital, or 9.84%. Weighted average cost of capital. The total dollar amount of capital employed is 0.0984 multiplied by 15 million. Total dollar amount of capital employed is 1,476,000. Then we compute for the weighted average cost of capital and EVA. After tax, operating income is 1,583,000 here given, and we divide it by 1,476 total dollar amount of the capital employed. So we have now the economic value added, defined as the difference between the after-tax operating income and the total dollar amount of capital. So finally, we have the EVA. For Man Incorporated, is creating capital because EVA is positive. Once EVA is positive, meaning it's creating capital. However, if it's negative, it is destroying capital. If the after-tax operating income exceeds the total dollar amount of capital employed, then the difference is EVA, which is positive. Okay, so I hope you take note of the formula and be guided accordingly by this set of examples. Next, planning incentive pay for managers. We have now the problem areas. Managers may have a low ability, prefer not to work hard, prefer to spend company resources on perquisites, remediations. Owners need to discover information about the managers before hiring them, monitor their manager, arrange an incentive scheme that will more closely align the managerial goals with those of the owner. Now we have to go back to the one of the basic principles in finance, that is the agency problem. Now see to it that the manager will work in favor of the company and do not make plans that will be detrimental to the company and destroy the company later. So you recall about the agency problem. Now, the managerial rewards, incentives tied to performance, objective to encourage goal congruence. Goal congruence, we have goals managers are closely aligned with the goals of the firm, consists of salary increases, bonuses based on reported income, stock options, and non-cash compensations. Now, cash compensation, salaries and bonuses, raises, way for a company to reward good managerial performance, bonuses, give more flexibility, combination of salary and bonus issues to reward